I made money in the stock market by being a passive index fund investor. I made money in real estate investing by being an active investor. And so even though both went up and to the right, I do believe, yes, I was fortunate in the timing of the market, but also I took action. I made a lot of great investments. So I want to welcome you to a webinar I titled Why I Moved $276,000 from Stocks to Real Estate and Private Lending. And I did this so I could go out there and build a non-correlated retirement portfolio that thrives in any market. So I actually did a version of this presentation about a year ago, but with all the recent volatility and downward trends of the stock market, I thought this was a really great time to bring back the webinar and talk about, because I've had a lot of these conversations off the webinar. So I decided to rerun it and update a few slides on the presentation. So the goals of this webinar on here is to go through strategies that could potentially increase your retirement income. And again, this is not financial advice. These are just strategies that I'm using. I'll walk you through my thought process and actually what investments I made with that $276,000, because I wanted to achieve greater diversification in my IRAs and 401ks with less volatility. And a lot of this was focused on how can I get non-correlated assets and why they matter for the stock. What non-correlated assets are and why they matter for your retirement. And I'll talk about specifically why I chose real estate and private lending for my rollover. And I'll give you a very quick update as to what a self-directed IRA is, which is something you need in order to invest in here. But first, before we get into good stuff, normal disclaimer, I'm not giving you financial advice. I'm sharing education and sharing my own portfolio moves. So make sure you go out there and talk to your CPA, your lawyer, financial advisor, and your professional team. And also, I'm sharing some live deals I've invested in, but this is not a solicitation for an investment. So my name is Chris Lopez. And the reason I'm obsessed with this topic is because my degree is actually in financial planning. I graduated with a financial planning degree from Virginia Tech in 2005. And I'm actually eligible to sit for the CFP or Certified Financial Planner exam. Now, I never pursued that traditional career path because I was just not a big fan of doing traditional stock and bond financial planning. And that's eventually what led me into real estate. But the thought process, the long-term wealth building, and that financial planning aspect and mindset has influenced all my investing and also all the content I've created and deals I've participated in over the years. So I have almost 15 years of active real estate investing and have since built a 7-figure portfolio. I'm also the co-founder of Property Llama, which is a software that myself and 2 partners designed for analyzing and optimizing your rental portfolios. It's not, should I buy the property, but how do you make your rental portfolio make you more money? And every year, I also author the annual guide to Colorado real estate investing strategies. So if you want the 2025 book, drop a comment in the chat or shoot me an email and we'll get you a book that just came out. And to kick us off on the webinar, actually in 2024, this is when I converted $276,000 from my IRA to real estate and private credit. Now I want to rewind and talk about why I did this. Because before I got into real estate, I was actually day trading the stock market and then day trading currency trading or foreign currency or Forex at the time. And I wish I had an old picture of my setup on here, but this is a pretty good representation of what I had. I had 4 monitors for day trading and then 2 monitors for work. I literally had 6 computer monitors like this. So it was hyper efficient, looked really cool, made me feel really cool. Here was a problem. My day trading and foreign currency trading underperformed the stock market. And really the only outcome I got was my eyesight literally got worse. I had to go out there and get new contact lens prescriptions a couple of times in that 2-year period because I was staring at 6 computer monitors about 11 hours a day between work and day trading. And since the day trading wasn't making me much money or actually any money, it was not a great quality of life. So what I realized is that I needed to go completely passive in the stock market. Me, like most people out there, I can't beat the stock market. And so I pivoted to Warren Buffett's 90-10 strategy. So this strategy calls for 90% of your investment to be allocated in like an S&P 500 index fund, like a Vanguard or Fidelity one with, zero or, minuscule fees, and about 10% into short-term government bonds. So I follow this, except for a couple percent I just have some fun money with, but this is where the vast majority of my retirement and stock market accounts are following the Buffett philosophy. And so, I pivoted into real estate, as a lot of you guys know, and I bought my first rental right in January 2011. And so what I was doing as I was comparing my returns over the years is, I made a lot of money in real estate. I did not make any money in day trading the stocks. And then someone asked me, they said, well, you just started investing in real estate when prices were cheap. And I said, yes, you're right. And I wanted to go out there and compare what the Denver market did and the stock market did. So that top chart here is actually the Denver market for homes and condos. And it shows when I started investing in about 2011, where that red line is beginning. And we all know what happened. It went up and to the right. It grew a lot. So did the stock market. I highlighted there on the bottom chart, the end of 2010, which is when I stopped day trading, or right around then, and started focusing on real estate, and then bought my first property a month or two later after that. And what the stock market do? It went up and to the right. And I made money in the stock market by being a passive index fund investor. I made money in real estate investing by being an active investor. And so even though both went up and to the right, I do believe, yes, I was fortunate in the timing of the market, but also I took action. I made a lot of great investments. So with that said, I look back, and since about 2011, that stock bonds is about 12.5% return, and real estate is about 20%. Real estate's a little harder to estimate. It could be higher. Some of the deals haven't sold or exited yet, but I would put it right there, actually in the low 20s. So I'm going to say 20% to be a little more conservative. So with that said, if I can make 8-9% more in real estate, that's what I want to see. That's why it's worth my active time and my energy. And then this kind of brings me back to today's relevant topic of what's going on in the market, what's going on in the economy, right? And this is the correlation problem. Essentially, when everything falls together. So here's the hard truth about diversification in the stock market. When markets crash, traditionally they all crash or they all go up together. Now, I'm in an S&P 500 index fund. I'm in some, total market index funds as well. And so I have diversification across, 500 or thousands of companies, which is great. I don't want all my money in, one or two or three companies, but I have great diversification in that standpoint. However, it's all in the same asset class. And for the most part, all of those are correlated. When they go up, they all go up. When they go down, they all go down, for the most part. And if you look at 2008, right, and I think it's a good time to go back to what happened in 2008. Well, I don't think we'll see anything dramatic like that in the stock market. We're already down 10% or so in the S&P 500. We're going to see some decline, if not more. Well, back then, the S&P dropped 37%. International stocks fell 43%. Corporate bonds tumbled 5 to 15%. They all went down. They all went in various stages of going down. Of course, real estate did as well back then. Everything was struggling back then. But that's a great thing to take away, is how do we get uncorrelated assets? How do we create an uncorrelated portfolio? So what is correlation? A perfect correlation, or 1.0, means everything moves identically, while 0 means there's zero relationship. Now, during normal markets, these correlations look reasonable, but in a crisis, they spike. And this is often when you need diversification the most. Has anyone been out there sweating the last, 6 weeks or 8 weeks, or I guess since, January kicked off this year? It's not been a fun time reading headlines or looking at your stock and retirement accounts. And so this is what creates this dangerous psychological trap. And I remember this is one of the reasons I did not want to become a financial planner, because when markets tumble and, tumble, crash, whatever you want to call it, a lot of investors start having panic, anxiety, and some start panic selling as they start seeing their entire portfolio drop. And I remember one of my internships I had for financial planning, they said, look, half of this job is just being a therapist. When markets go down, you're calming all of your investors and making them stay and hold the course. So they don't go out there and panic sell, right? What happens is they end up selling low and buying high, is what a lot of your typical stock investors do. And that's one of the reasons why I did not become a financial advisor. But that tip stuck with me so I could hopefully avoid that myself. And I think for the most part, I've done a pretty good job of minimizing that. But as I've gone into real estate investing, I've kept that in mind as I've helped clients go out there and buy real estate. And so this matters for, portfolio design and allocation, but especially if you're near retirement. A major crash right before retiring can have some permanent damage to your portfolio's growth and income potential. And I think this is one of the reasons I did not become a financial planner, is because there's so many more assets you can go out there and invest in beyond the stock market, right? Diversification, or I should say true diversification, isn't just about owning different stocks or adding bonds. It's about having other assets that make money through fundamentally different mechanisms and then have a different correlation, not a 1.0 correlation to the stocks and bonds. Now, understand here, I'm not saying stocks and bonds are bad. I still own a lot of stocks and bonds. I love them. But I also own a lot of other assets that are non-correlated to the stock market. So here's a very simple chart that shows kind of a traditional portfolio or traditional investing on the left. It shows mutual funds, ETF stocks making up the majority of the portfolio, with bonds being about a third of it, right? We all know stocks and bonds, right? That's what a lot of people have, especially in your IRAs or 401ks. That's about the only options you have, is investing in mutual funds and bonds. Well, the picture on the right is a non-correlated asset allocation. And this isn't mine or any advice. This is just one I got off of Google that shows a good job of how to create non-correlated assets. 8% in bonds, 21% in credit or private lending, 20% in public equities, 4% for cash, 15% in real estate, 21% infrastructure, and 19% in private equities. So a lot more diversification there and a lot less correlated assets when it comes to how your portfolio looks. Here's a problem, though. Your traditional IRA or your traditional 401k with your employer or your past employer is only limited to stocks, bonds, mutual funds, or ETFs on the high side. Or, some employers, you have, 10 mutual funds to pick from and 2 bond funds to pick from. So everyone's familiar with that. And these are managed through conventional brokerages. Now, you cannot invest in non-correlated assets or alternative investments when it comes to going out there and creating a diversified non-correlated portfolio. And this is where a self-directed IRA or a self-directed 401k comes in. What this does is this allows you to access alternative assets, the real estate, the private lending, the private equity, cryptocurrency, all this other stuff that you can invest in that's not a stock or a bond. Now, this does require a specialized custodian, like Fidelity or Vanguard, or your employer is not going to give you a self-directed option. You have to go through a specialized custodian where that is what they focus on. They don't focus on traditional portfolios. They focus on alternative asset portfolios. Now, there's a lot of rules around here, and there's a lot more nuance. I'm keeping it very simple because there is so much information on the internet about how to set these up, and should you do a SEP or an IRA or 401k or what you can roll over. Go Google those, or I'm happy to send you a couple resources of custodians that I've used for like the technical how-to. I don't want to get stuck in that boring stuff. I want to stay focused on how you can protect your portfolio and hopefully increase your retirement income as we all get closer to the retirement age. But here's the punchline. The biggest difference is that the self-directed IRAs and 401ks just gives you a lot more freedom what you can invest in. You have the same tax-deferred or tax-free growth if it's a Roth. You have the same contribution limits, same distribution rules, and same early withdrawal penalties. The big difference is you have to be a different custodian and you can invest in different assets. Now, the first question I always get when I talk about rolling over $276,000 is, they say, oh, Chris, you're a real estate guy. You went out there and bought rental properties, right? No, I did not. So when investing in a self-directed IRA, owning directly owned real estate or rental property is really tough. Two main reasons is, one, there are non-recourse loan requirements because they cannot use me as an individual, Chris Lopez and my wife and our personal balance sheet. They can't use our credit scores and other assets. They can only look at what's in that IRA or 401k account. This often results in like a 40 or 50% down payment and interest a couple points higher than traditional financing. The second thing is there's a lot of compliance rules around what you can do. And the IRS calls this prohibited transactions. You can't self-manage. You can't go in there and do sweat equity. You can't go in there and manage the property yourself. Everything has to be third-party contractors and third-party vendors to go out there and manage your property. The bottom line is that when I've looked at this, and I've talked to a lot of clients about this, the bottom line is the numbers simply don't pencil out for owning rental properties. So if you can't own rental properties, what other type of real estate assets can we go out there and buy in our IRAs? So I'll walk you through the two that I personally invested in. Now I'm gonna give you the high level and actually go through a lot more details here in later slides. So the first is private real estate lending, or AKA becoming the bank. So what happens here is your retirement account provides loans secured by real estate. So you become the lender, meaning you're lending the money, the 50, 60, 70% of the value of the property, rather than the 20, 30, 40% down payment or equity investor. You're typically in first position, so you have a lot more security, and then you're collateralized by the real estate. So a lot of times this is for fix and flips or acquisitions or small development projects. So the reason private lending has advantages is because it has consistent and predictable income that's not correlated to the stock market. It's collateralized by tangible assets, by real estate, here in Denver or other parts of the country. And most importantly, you don't have the management headaches or tenant problems with buying the properties yourself. So why do I prefer private lending in my retirement account? Well, one is typically these returns outperform traditional fixed income by 3 to 5x. And you also have income generation without correlation to the stock market. Plus, it avoids all the prohibited transaction rules I talked about. And you have none of those non-recourse lending issues because you're the lender, not the borrower. So there's really two main ways you can implement this in your IRA, I should say in your self-directed retirement account. The first one is you can do direct lending to individual borrowers. So what that means is I go out there and I find the deals, I do the underwriting, I review them myself, I evaluate it, and then I make the loans myself. So I have a part-time job of going out there and sourcing deals, underwriting, and then a lot of times I'm funding the whole loan. If I can't fund the whole loan, I am probably not in first position. So a lot of times this might be 50, 100, 1,000, even higher, depending on the market or the type of asset you're lending with. And then your retirement account with you as a trustee are going to manage the documentation, the closing, the potential foreclosures, all of that stuff. So that's option one. Option two is to invest in a debt fund. And so let me just show you what a debt fund is. So here's a very simple graphic where the private investor, that's me, that's you, or that's our retirement accounts, right? Rather than us going out there and finding the individual borrowers and the individual deals, we are investing with a debt fund. And so this could be a hard money lender. I know we all know hard money lenders, and most of them have money they've raised from private investors, people like you and me. And a lot of times people invest in hard money lenders through their retirement accounts and trust. So rather than me going out there and having to spend my time and then learn the skill set of underwriting loans, the debt fund does it, or the hard money debt fund does it for you. So this is that second rectangle in the middle. So they're the ones out there underwriting, issuing loans, ultimately to the real estate borrower at the bottom of it, where they're going to borrow for a fix and flip or development deal or maybe a bridge loan for a project. And then coming on the right side here, that borrower pays interest and principal back to the debt fund. They collect everything. They take care of the paperwork. When people are delinquent or unfortunately when they have to foreclose, and it always happens at some point, foreclosures are part of the business, they handle all that. You simply just receive your quarterly or your monthly interest payments paid to your retirement account. So I have I have invested in a debt fund because I don't want to spend the time, nor do I have the expertise to go out there and do the loans myself. Now, the second area that I have rolled my $276,000 into is into real estate passive investing. And so these are like the equity deals, so the other side of the capital stack from lending. So these are syndications and various funds. So here's a picture, and this also applies to the debt fund I talked about earlier, where on the left side, I'm the investor, or again, my retirement account is the investor, and it is the limited partner. It invests money into these bigger and more complex projects. They could be a 200-unit apartment building. They could be building a 100-unit apartment building up from the ground. It could be a debt fund that has 300 loans they lend out. The GPs, the people on the right, they're the managers, they're the owners, they're the people taking the risk, and this is their full-time job, this is their business. And so they're the ones out there taking down these big projects that I can't do on my own. So if you're the GP on the deal, they can't use their IRA to invest in their own deal because that would be a prohibited transaction. But since I'm not actively involved in the deal, I don't have to worry about being a prohibited transaction or the non-recourse lending or the other headaches. I simply write the check and I receive my dividends, interest, payouts, whatever that deal structure does back. So what this does is it gives you access to higher quality assets that normally like a solo investor or solopreneur simply can't do on their own, like the commercial buildings, the apartment complexes, and big development projects. And then also you're not involved in the property management. They're handling the asset management, the property management. They're handling all the headaches, the good, the bad, and the ugly, right? And then another reason I like this is if I'm out there managing all the assets myself, I'm going to have more money into one deal and more time and more focus on one deal. Well, since I'm simply investing or writing checks, I can be in multiple properties. I can be in multiple investments, which gives me a totally different type of diversification, geography, and different people running the projects into different asset types. And it really reduces the impact of, one deal, one property. When it does go sideways, because we always have eventually a bad deal, it really mitigates that downside risk. And then this is a big thing I like is I am not having to personally guarantee any of the loans or manage any of the properties myself. So if you guys have questions, drop in the chat box here. I'm keeping an eye on there. I see a few in there that I'll actually be answering in about 5 or 10 minutes. But if you have them, keep coming. I do see a few people who want copies of the book. Feel free to drop that message and we will get you a book here in the near future. Okay, so I want to talk about my personal strategy for my IRA rollover. So I gave you some background on my financial planning background, gave you the background on how I failed at day trading, then how I had success at real estate investing, and then how I want to have a non-correlated diversified portfolio. So these are 3 bullet points that really influenced how I want to deploy my IRA rollover money. Number 1, I believe that real estate can outperform the stock market. Number 2, I want non-correlated assets. Number 3, I needed investments that were self-directed IRA compliant, so I go out there and stay compliant with them. So here's a screenshot of actually what I do with my investments on here, and I'll break down a lot more of these details in the next few slides. So I'll come back and do a line by line breakdown on here. But I want to show you on the left side here is if I kept that $276,000 in the stock market in year 5, and I'm assuming a 10% return, right? Rate of return, that's on the left column there. It says 90-10 stocks and bonds. I'm assuming a historical 10% return. I read somewhere from 1962 to like 2023 that 90-10 Buffett strategy was a 9.9% return over those, 60 years. So my 276 would be almost $444,000 in year 5. Now, if I take that same money and I go out there and invest in real estate and hit that low 20% annual return that I've hit in the past and believe I can continue to achieve, in year 5, I'd be around $1.38 million. That is almost 3x of what I could do in the stock market. Now, again, not financial advice. I've not sold all my stocks and bonds. I just moved over a portion of my portfolio to get more exposure to real estate and real estate private lending. So let me walk you through these investments and we'll come come back here and talk about the spreadsheet in more detail. So I'm just going to go over from left to right and talk about the deals I invested in. These are all real numbers and real deals. So investment number one, this was into a private lending debt fund. So I invested $150,000, which is about 54% of that $276,000. So this is everything I talked about, where this is with a group called Dynamo Capital out of Kansas, Wichita, Kansas, and do hard money lending in the Midwest. So there's not much competition on there. They can charge a premium. They've got some very unique products. Last year, they had a 32% annual return, which I don't expect this year. It'll be more in like the 20% range, which is still phenomenal. But it's a great business that I liked a lot. I've known them for a while. I wanted to invest money with them. Keep in mind, I always have to get the disclaimer since I shared a number from last year. Past performance never guarantees future performance, right? We all know that. So the way they do that is by having two loans. One is they give you your standard fix and flip loan or development loan, where someone needs, money for 6 months to do a fix and flip, or someone needs money for 10 months to go out there and build a single family home. So they do those value add loans to borrowers, anywhere from like 3 to 4 points and like 12 to 15% interest rate. So a lot higher rates than what we see here in Denver if you ever had a hard money loan. The second thing, and this is how they're able to give a lot higher returns than your typical debt fund, they include origination fees at 3 to 4 points on the origination of the hard money loan. Plus they do a lot of long-term financing, do a lot of burrs. If people do fix and flip, they may sell it or they may keep it as a rental. I think a lot of us used to do that here in Denver when the numbers made sense. Well, in other markets that are not Colorado, the burrs still make sense. So they generate a lot of origination fees on there as well, which they're able to pass back to their investors. So here's just a sample, $100,000 investment, assuming that 26% return they're targeting for 2025. It would generate about $2,200 a month. Now, of course, not every month will be exactly the same like on here. It will fluctuate between like 1.5 to 2.5% a month. But at the end of the year, it should be around that 25 or 26% range. So that was my first investment I made, was into the debt fund on there. So I could have non-correlated exposure. Plus, I could go out there and have consistent income for my retirement account. The second investment I made was into the Colorado Multifamily Diversified Fund. Now, I invested $50,000 in this fund, which represents 18% of the capital from my rollover. And so this investment and the other investment, these both happened last year in 2024. So this investment goes into 3 Colorado multifamily developments, 1 in Wash Park and then 2 in Colorado Springs. Essentially, this acts like a mini mutual fund for real estate investing. One investment is into 3 deals. So here's just a couple pictures here of what the projects look like. This is the Wash Park project. This is their downtown Colorado Springs. And this is their northern Colorado Springs project. Just want to show you some pictures. And these are all conceptual drawings. These are still have not been built yet. But that's the end product of what they're expecting for. So why do I like this? Well, one, I like Colorado a lot, but I like those submarkets a lot. I like Wash Park a lot because there's not much new construction. There's like hardly any new construction for apartments on there. And also, I'm a lot more bullish on Colorado Springs than Denver. I'm also very opportunistic on where we are on multifamily right now. Multifamily is getting hit hard right now, but in 2 years when you start delivering, it is forecast that the market should be in a very different place than it is now. And then a bunch of other reasons on here. Won't go into details. It's just a non-correlated investment that makes a lot of sense for my real estate knowledge in Colorado, and also for my own, portfolio, the architecture as well. So investment number 3. This is into a build-to-rent single-family home community, and this is in Ohio. So I just made this investment this month. And I invested $50,000, which is about 18% of my 276 rollover. And so let me show you a picture of this. So this is not the actual one. It's not been built yet, but this is a previous one that this developer built. So you can see here, it looks like a standard subdivision, right? There's hundreds of homes on here. And unlike your typical subdivision where they build it and then sell home one to homeowner one, home two to homeowner two, what it is you're a fractional owner of all 200 or 300 homes, and they rent them all out. So it's essentially a giant apartment complex of single family homes. So rather than owning one rental, I own a fraction of 200 properties. So I get diversification. So I'm not having all my money into one property. Rather, it's spread across 200 properties in the same location. Plus, I wanted to go out of state. I have a high concentration of my real estate net worth here in Colorado, and I want to start moving it to other markets. So while I love Colorado, I'm keeping some of my money here. Some's going out of state. This is Ohio, so a much more landlord-friendly state. A really good economics here in the sub-market they're in. And then they're using all the typical right things to mitigate risk. A low loan to cost developing the property. This is not their first rodeo. They've built a bunch of these in the past. So I feel like it's a very safe investment in my mind, where I can go out there and invest money with good downside mitigation protection and strong upside. So I'll just show a few pictures on here because this is, I think, the next big thing in multifamily. You can see here, these are the community amenities, and it looks like a Class A apartment complex that you would have in a 200-unit apartment building. Rather, this is 200 single-family homes. So you got the playgrounds, the clubhouses, the pools, the common areas, the dog parks, and you can see here in that bottom center picture, these are great places. They have stainless steel appliances. People have their own fenced-in backyard, so it's very attractive to residents. So if residents like it, that usually makes it a better investment as well. And they're a combination of 1-bedroom, 2-bedroom, and 3-bedroom units. And I'll share all these slides when I want some as well for the pictures on there. So the fourth investment I made out of that rollover was a multifamily value add deal in Oklahoma City. And I deployed $25,000 or about 9% of my total rollover into this. So this is your typical value add where they bought a distressed multifamily property where they got it for a great price. And then they're going to go in there and fix up and essentially do the BRRRR strategy. They'll fix it up, spend about a year fixing up, getting the rents up to market rent or above market rent with a couple of years of some good cash flow, and then sell a property in year 4 or year 5. And I like this because I know the operator very well. And also, again, this is in a different market. That's outside of Colorado. I'm keeping some money in Colorado and I'm keeping some money outside Colorado. So I have moved this money to Oklahoma City. And so this leaves about $1,000 left over out of $276,000. $1,000 is just sitting in a checking account right now at my IRA. So I'm not too worried about $1,000, not being used at the moment. But now I want to come back to the spreadsheet here and actually walk you through the numbers in a little bit more detail. So in this line where it has a yellow line, these are the expected returns I'm anticipating these investments to make. So the 90-10 stocks, they are going to be doing about, I said, a 10% annual return. Now that's the historical average, right? We've had some years way better than that. We've had some years way worse than that. I think this year will be probably below that. So I'm very glad I sold my stocks actually about 1 year ago is when I actually sold this and started the transfer process to a self-directed IRA. So this first one, here's that private real estate lending that I'm doing in Kansas. I invest $150,000 on there, and I put an estimated 24% return on there per year. So what this spreadsheet does, it just does a simple compounding of, hey, year one, it multiplies your investment by 24% or 10% for stocks. So I'm modeling my $150,000 at that 24%. That next column over here, a Colorado Apartment Development Fund. This has those 3 deals in Wash Park and Colorado Springs. I invested $50,000 into that. And they're anticipating somewhere around a 22 to 25% return, annual return on there. So I put in 22%. And it may sell before year 5. It'll probably be a year 4 investment. I'm kind of doing some simple numbers for modeling on here. And I'm just kind of going year 5 for, modeling all this stuff. Well, hopefully by year 5, that $50,000 will turn into about $135,000. That next column over, that build to rent syndication, this is that subdivision in Ohio I talked about. I invested $50,000, and they're anticipating about a 21% IRR. So in 5 years, that $50,000 should be at $129,000. And then this last deal is the multifamily value add deal. And I realize that should say $25,000 versus $26,000 in that screenshot. Won't make a big difference. Extra $1,000 won't make a big difference in the portfolio. But they're anticipating a 17 to 20% return on there. So on the lower side of 17%. And then by year 5, that should be worth around $50,000 to $60,000 as well. So if you've got any questions, let me know on here, and I'm happy to hop on a call or also give recommendations for any self-directed IRA custodians. But I wanted to leave a bunch of time on here so we could go to Q&A on here for how things are looking, for how things are looking in the market and any questions people have. Because the punchline on here is with how much volatility we've had in the stock market and how much we've seen the S&P 500 go down this year, a lot of people are looking for alternative investments. And so I'm a big fan of real estate. I'm a big fan of real estate private lending. Now, of course, you can go out there and do crypto. You can go out there and invest in businesses. You can go out there and invest in, precious metals. I'm not an expert in those, and I do just a very, very small amount investing in those. The vast majority of my wealth is in real estate and stock market. So I see a couple questions on here, and start typing them in here. Someone says, how can these guys return around, talking about the debt fund. So how can these guys return a 26% return each year when the underlying loans are 18% plus the 3% origination fee? Yes, you heard correctly. So there's two main reasons on there. One is the velocity. So most of those, I think their average loan term is like 5 months or 5.1 months. So you're usually turning money over like 2.1 or 2.2 times a year. So they're getting the interest on there, but if they turn that money over twice a year or 2.1 times a year, they're getting that 3 or 4 point origination fee twice a year. And so this is the biggest difference with how this debt fund is structured versus other debt funds, is that they go out there and they share the origination fees. Where most debt funds just share the interest with you, they share some of the interest and also share the origination fee. So that's number one, how they give a higher return, is they share the origination fees and turn over the money a few times a year. The second thing is they do a lot of DSCR, or debt service coverage ratio loans. These are also called investor loans and bank statement loans and income only loans or property loans. There's 50 different names for them, 50 different names, but they're essentially DSCR loans on what they share in their fees. So I'm sorry, the DSCR loans is they're one of the few hard money lenders actually issues those loans and actually shares those origination fees. I think about 40% of their flippers don't flip the property, but actually do the BRRRR, where they keep the property and do long-term financing. So most of their investors are experienced, and they don't want a traditional Fannie or Freddie loan because of the paperwork, and also DSCR loans right now are actually having a better interest rate than investor loans. They're in like the 6s versus the 7 or 8s for traditional financing on there. And then they are sharing, they usually get like 2 points of origination. But here's the kicker. They don't hold these loans on their books. They're not holding a 20 or 30-year loan on their books. They're turning around and selling to a life insurance company. And that life insurance company will buy it the day of closing or within a week. So they all have very little money deployed. So they're able to give a 2 or 3% return typically with very little fund capital deployed. I see a few questions on there. About, we'll love seeing the math. Yes, I can share that with you. We have actually a very detailed video. We actually go through a spreadsheet and show all that. So I will make sure I get you a copy of that. I see 3 people asking for that. If you guys want a copy of that spreadsheet walkthrough as well, let me know. I'll drop it. I'll send you guys a link later. But you're not the first person to ask that question. I have the same question, and we went out there and did an on-site audit, checked everything out, and very, very interesting fund they have and how they're able to generate fees. All right, let me read these other questions on here. Yeah, some people saying thank you. I see some detailed questions underwriting. I will defer that to the videos and the recordings I'll share with you, just so we don't go down a rabbit hole. And also, I don't want to like misspeak any numbers on this webinar as well. So a couple people are asking for companies that I recommend. There's actually a lot of great custodians out there, right? So understand there's not one custodian that does it all. There's a lot. Now, there are two types of custodians out there. One is your common one where you set up your account with them, and whenever it comes to make an investment, they are sending the money on your behalf and taking care of a lot of the admin stuff. The other one is called checkbook control. And this is where you can go out there and actually be your own custodian and write your own checkbooks. So let me pull up a few websites here to actually show you guys about this. Like I said, there's a lot of great resources. I'm gonna see if I can pull this over to the webinar here. All right, so here is one company I recommend a lot, and this is what I personally use, sensefinancial.com. So I actually have a solo 401k. Since I am self-employed, I was able to set up a solo 401k, works very similar to an IRA. I rolled my money into that, and I wanted the checkbook control. But they're an awesome custodian and have an amazing resource center on there. So you can go to Sense Financial. The other one we recommend a lot is Equity Trust. So this is not a checkbook control one. They're much more like the full service, where they do a lot with you, and there's a lot less compliance on you, and it's more on them with the administration work. So I recommend Equity Trust as well. The other one I like is New Direction IRA, and this is actually a local company. I think they're up in Louisville. So ndco.com. And I will send an email with all these links as well so you guys can see it. But those are all three great custodians. I've had investors and clients use all three. And other than your typical headache here and there, they all take care of their clients. They're all great custodians. It just kind of comes down to what your preference is, as if you want checkbook control or not. But those are the three I recommend all the time. I recommend you talk to all three of them. And there's also a lot of other companies that do amazing work as well. So there's a lot more custodians than just these three as well. A question on what the debt fund is. So that debt fund we invest in is called, I invest in is called Dynamo Capital. And in full disclosure, and that's one, I do marketing services for. We help them sell their DSCR loans. And we've actually pulled together a lot of other investor money to go out and actually get better terms with them as well. They take a lot of family office and institutional money, and we're able to bundle a lot of smaller checks together out there as well. So we actually help bring capital to them and provide marketing and investor relation services. So I can send you details on there. Couple people saying, what other hard money lenders I invested in the past? So I've invested in a few over the years. I like private credit a lot. Two great ones here in Colorado are Pine Financial and Indicate Capital. I've done a lot of work in the past. They're great ones as well. I'm always a big believer in giving multiple options for people. So there's a lot of great companies here in Colorado. Someone said I was having tech issues. But did I hear that you can access the funds without penalty, or do you need to wait until a qualifying age? No, you got to wait until a qualifying age on there. So the only difference, get back here. So the main difference in these funds, there we go. So no, you still have to wait to your retirement age to go out there and get access to your money. It has all the typical rules. A self-directed IRA has all the typical rules that you have with your traditional IRA in terms of contribution limits, the 7,000 or whatever it is for IRAs now. Same distribution rules. You have to wait until you're 59 and a half to start taking things tax-free. You'll have your required minimum distributions for traditional, IRAs and 401ks, not your Roth. And if you do withdraw the money early, you have the same penalties, or the same, kind of like Roth version where you can withdraw some money from there. So same rules for that. A couple people asking about what banks I'd recommend. Yes, I'm drawing a blank on the names of the banks I use. Oh my gosh. Okay, I just popped in my mind. So two banks that work well for self-direct, especially like that the checkbook writing one, is a Solera Bank, Solera Bank. They're actually here in Lakewood. They're off of, I think, Sheridan or Federal, but they specialize in that. Another one is Titan Bank. I've used Solera. I've had clients use both, and Titan Bank is the other big one that I know of, and there's more out there, but those two banks do specialize in like retirement and self-directed IRAs and 401ks. And I've been happy or have heard good things about both of them. So I would look at those two banks as well. And I'll put all these links in email afterwards as well to give everyone a lot more access. Because like I said, I started my own self-directed 401k, I think in 2020 or 2019, after like a couple years of researching it. And what happened there is, I started investing in real estate in 2011, and I looked a lot at, I was, I can use my IRA to go out there and invest in rental properties. Well, every time I underwrote a property or underwrote a property with a client, I would just say, man, these numbers, why? They're not that great. Just go invest in the stock market instead. That's what I personally did. And I talked myself when I used to be an investor-friendly broker, I talked myself out of 50 transactions at least when people want to buy with their IRA. I was like, look, let's sit down, go through numbers, and make sure you understand it first before we go out there and spend a bunch of time. And also, when I've done my own homework, the deals have not been attractive to me. So when I was heavily buying, active rentals myself with, my non-IRA money, I didn't like the returns using an IRA because I talked myself out of dozens and dozens of, clients out there as well, because I wanted to like, hey, here's the numbers, and I don't think these numbers make sense. And in my entire career, I did 0 transactions as a broker with retirement accounts. And then once I started Property Llama Capital, we probably had close to 100 people, 100 people use IRAs or self-directed IRAs to invest in the passive stuff, debt funds and syndications. In my opinion, based on the math and the rules, they make a lot more sense to IRA. And I started mine in 2019 or 2020. So I'm happy to sit down and talk with people in strategy or give you some nuances as to what the best setup is for you. Again, not financial advice. I'm just sharing my education on there. Someone says, I heard First Bank also does self-directed IRAs. Do you know about theirs? I have no idea. Wouldn't surprise me if they did. But I don't know anything about First Bank. I've worked with them in the past for other stuff, but not self-directed IRA stuff. Another question on here. Someone says, hey, can you also invest non-IRA money with these types of vehicles as well? Yes, you can. So I kept this really geared towards retirement accounts because, most people, their largest chunk of, cash or investable assets is in an old IRA or an old 401k, where people have, hundreds of thousands of dollars, sometimes, millions of dollars in those accounts. And so I really wanted to gear it towards that, especially as a lot of people are, looking to diversify away from the stock market. But all these investments you can invest directly as well, not through your retirement account. Like I have a lot of money invested through my 401k, I should say my self-directed 401k. I've also invested in a lot of these deals in my non-retirement accounts as well. The biggest difference there is when I make my investment personally, it's Chris Lopez. When it's through my IRA or 401k, it's through my 401k name. And what ultimately for most of these deals, you have to be an accredited investor for, whether you're doing a retirement account or a individual investment. You as a person or you as a couple, if you're married or have a partner, you have to be accredited, which means you make $200,000 in income if you're single, or $300,000 if you're married, or have over $1 million net worth in investable assets. So whether you're investing to your self-directed retirement account or your personal stuff, for the vast majority of these deals, like 99% of these deals, you have to be an accredited investor for. All right, I know we're getting up on the time here. All right, if you guys have other questions, I'm just scanning through here. Yeah, a lot of deal questions. I'm happy to send out specific, questions to deals, deals I've invested in, deals I've helped put together. If you guys have questions in general, reach out to me. Someone here says they're a real estate agent. Could you talk more about a solo 401k? So, too many options on here. And I'm going to go back to this other screen if I can make my computer work. I'll nerd out with you guys for a minute if you don't mind. So there's two main types of retirement accounts you can do. You can do like a solo 401k. And so this is really good for people who are self-employed. Realtors, solopreneurs, small business owners. And what the rule is here, this is like your typical 401k where you can invest, you can put your employee money aside, $22,000 or $23,000 a year. And also the employer side can as well. So you can stash a lot of money this way into retirement accounts. And I do this personally and actually convert it to a Roth so I can get, hopefully better tax advantages in the future. But the biggest thing there is has to be a business owner, and you can have like no employees other than your spouse. So you have to be self-employed and no full-time employees. So that's the biggest thing right there to do a 401k. So if you're a realtor, which I know a lot of people on this webinar are realtors, I'm one and used to do a lot as a realtor, and a lot of fellow realtors I've worked with. The solo 401ks are amazing because you can help stash some of your income away into that and then continue to invest in deals. And you can invest traditionally or as a Roth IRA. You can also transfer an IRA or a previous 401k you had an employer into here to get more money into here. Now, if you're not self-employed or you have a business with full-time employees, this is where the IRA comes into play a lot, where you can go out there and set up an IRA or a self-directed IRA, where you can start from scratch and do the $7,000 or $8,000 a year contribution. You can also roll over IRAs and also old employer 401ks as well into there. So if you're a business owner with no employees, or say if you're self-employed with no employees, the solo 401k is amazing. If you're not a self-employed business owner, then I would go out there and look at a self-directed IRA. Now, a quick note on here, I do use solo 401k and self-directed very interchangeably. Technically, they're different names. I just say self-directed for simplicity and ease of use. But definitely go out there, check out this website, check out Equity Trust website, check out the New Directions website. Of course, use Google and use AI as well to go out there and get more advice. All right, some questions on here. Yes, can send out the slides. Someone else said, is the 2025 book electronic? No, it is not. This is about the only thing I do that's not electronic. We actually print physical copies every single year. So as of now, it is paperback only. But if you drop us an email with your address, we're happy to send you a copy in your mail. We have not made an electronic version of it yet, though. Yes, I'll send out the slide deck later. Yes, I'll send out the links. A question on here is, do you still get the full tax benefits of real estate, such as depreciation? Very complicated answer. Really not. You really don't use a whole lot of depreciation in these investment accounts. So depreciation, the way I view it is depreciation is, great for non-retirement accounts, but for, retirement accounts, I do investments that are less depreciation focused, like development projects, and also like the lending does not give you depreciation. So I keep a lot of my investments with heavy depreciation outside of retirement, and I keep a lot of development projects and the lending inside of my retirement account as well. Now, there's a lot more nuance on this, so go check it out. One of the things that everyone should be aware of, and I'm not an expert on here, But as you do self-directed stuff, you'll want to make sure you learn about UBIT, the unrelated business income tax, because depending on the investments you make, there can be some taxes your self-directed IRA can owe in the IRS. I'm not an expert. I also use a solo 401k, so there's a lot less rules around that. But make sure you understand how depreciation works in your retirement account and how UBIT affects it. And I am not well-versed enough to give you much more information beyond that, other than go out there and research and talk to someone who's smarter than me about those specific nuances on there. Like I said, from a high level, I keep a lot more of my investments that don't have depreciation benefits in my retirement accounts, and ones with depreciation benefits I keep outside. Now, of course, I cross some, but that's a very high-level strategy on there. All right, great. Well, we are at the hour-long mark, so it's time to wrap up. Amazing questions. Thank you guys for coming out. I will get an email out here next day or two with all the links and resources, and happy to share anything. And if anyone wants to go out there and talk, overall portfolio strategy, or talk about how to kind of find and analyze investments, I'm happy to. This is what I love. So I do myself, and also what I do for my business as well. Just take my own passions or my own investments and tell people. And like I said, my philosophy here is to be as transparent as possible, in the deals I'm investing in. And these are all real deals I invested in and real money that I've invested in. So I'm happy to kind of share the details and my thought processes and all that, and hopefully help give you guys really great education, really good guidance, and inspires me to go out there and make the right portfolio moves for you, whether it's non-retirement or retirement accounts, especially in these very volatile times. Again, I'm a big fan of diversification and a big fan of non-correlated assets. All right. Well, everyone, thanks a lot and enjoy the rest of your day. Bye, everyone.